Welcome to Money Talks. I'm Genevieve Westcott with your latest financial news from across New Zealand and around the globe. In this edition, here in New Zealand, the unemployment rate may be falling, but are we adding enough new jobs? And how many more public servants will face the axe with John Key's tough love approach for the economy? Australia's Reserve Bank holds the line on interest rates, but the big banks across the ditch are upping theirs. What will it mean for us here at home? And the Greek deal is done. Sort of. Plenty of budget cuts looming, belt tightening all round. So how come Eurozone finance ministers still aren't happy? Joining us today is KPMG Agribusiness partner Ian Proudfoot and head of Agribusiness for BNZ, Richard Bowman. Richard and Ian, both of you, thanks for being with us on the show this year. First time for both of you so far. You're based in Christchurch. How is the rebuild coming?
The earthquake story in Christchurch is actually one about people, Genevieve. It's the people down there are finding it difficult, but they're showing a lot of resilience, and it'd be fair to say we all know our neighbours a little bit better this year than we did maybe 2 years ago, which I think is a positive to come out of it. The rebuild is slow. There's purportedly $20 billion to be invested down there, so I think the Christchurch and Canterbury economies will benefit from that in time, but it's getting the planning piece right is a crucial aspect of that, and there's a lot of work to go in there yet. So.
What's your take on what's happening down in Christchurch, Ian? We've talked about this all through last year. No end of the aftershocks. The rebuild is pushed back.
The future of the New Zealand economy really needs stimulus quickly if we're going to get out of this flat line that we've probably been sitting in now since 2008. Canterbury is the obvious way to do that, and a lot of that money is coming from offshore. We really need that money to come into this economy, and you can see that the insurance companies are covering to pay the amounts because the dollar's staying high, and that's definitely one of the factors we're seeing is keeping the dollar up. But until it stabilises and until we can actually get things in the ground and start building, I think it's making the situation very, very difficult for a recovery in this economy.
Now, you come from a sheep farming background.
Yes, I do.
Educated at Lincoln University.
That's right.
Tell me about the agribusiness economy for 2012. What are you expecting in the coming months?
We're expecting to remain very positive. We're seeing commodity prices hold up very well. The currency is a little bit of a concern, I guess. We expect farmers to probably spend a little bit more money this year, maybe, on catching up on development and repairs and maintenance, etc. But and I guess we think that farmers will spend money really wisely on things like debt reduction, family succession, diversification, the development, these sorts of things that are going to really add value and create wealth for themselves and their families. So,
Ian, what do you expect for 2012 when it comes to the agribusiness world here in New Zealand?
I'm not expecting as positive a year as we had in 2011. My take is I think the global economy is looking far more unstable than it was 12 months ago, and I think that will play into demand for some of the high margin proteins that we produce, and therefore I think we'll see a slight decline in pricing. The key for me is that we really need to get moving while we're still in a relatively strong position on some of the key things, how we collaborate more, how we bring more innovation through, how we get closer to our customers. I don't think we're making fast enough moves in that direction. I really think we need to start pushing that faster and really having some industry-wide strategies to drive that.
Yeah, unemployment here remains a real soft spot for the government. How are we going to get around that?
We need to create jobs, and simply confidence drives jobs. And while we're in this flatline position in the economy, there's no confidence there. And the clients we're out talking to at the moment in the agri sector and much wider, none of them have plans to make any big investments unless they're trying to replace something that's been damaged by the earthquake. And we need that confidence, because without it, jobs will slowly just erode away because technology will continuously replace those jobs.
We're finding that people are a lot more risk adverse than they have been previously, and perhaps not prepared to borrow and take on the risk and I guess create those jobs that Ian's referring to, because they want to reduce debt and all the things that I guess would stabilise an economy and make a business more resilient. That's really important to them currently.
Are the banks willing to lend?
Most certainly are. We're most certainly willing to lend. We've been very supportive right throughout the GFC. The New Zealand banking system's been very stable. I think that's a key aspect why we haven't been impacted to the same degree as other parts of the world.
Now, last week we saw the Australian Reserve Bank hold their official cash rate, and yet some of the banks jumped in and started booting up the interest rates. Are we going to see that here, Richard?
The way banks fund themselves is changing a little bit more. In New Zealand, we have to fund more in deposits and more longer term to ensure solidity of our banking system here. And it's something that the banks have shown a lot of been very conscientious in doing that, and we'll be able to continue to support. So one aspect is we're most certainly seeing a decoupling of interest rates from the OCR to what actually consumers may pay.
So best advice to farmers when it comes to mortgage rates, floating or fixed?
All farmers have very, very different sets of circumstances. I know this is a very PC,
diplomatic answer.
Very diplomatic answer. You know, some are more risk adverse and will prepare to float. Some are not, and if it keeps them awake at night, then they may choose to look to fix something. Again,
are the banks here going to follow suit of the parent companies across the ditch? Are we going to see interest rates going up?
I think at the moment there's a prospect that interest rates will go up. Just the cost of borrowing globally is increasing. It's difficult to know. We live in such uncertain times, but it is a prospect, most certainly.
And we live in such global times, a global financial crisis, GFC, even school kids now know that moniker. We thought that some of the problems in Greece were being solved. The Greek parliament did pass the bill saying that they would make those tough cuts, but it is absolute chaos in Greece. What are you picking?
Greece is the sideshow, and really what happens in Greece isn't going to have a major bearing. What it's saying though is how can the euro stick together? How can they continue to work as a single currency bloc? And it's very clear it's not working as a single currency bloc because there's too many diverse economies without standard sets of rules. You know, it's interesting today to see the Italian government's just pulled the Rome 2020 Olympics bid the day before it's due to be submitted. And they've pulled that because they can't guarantee the funding. They can't give the government guarantees that they'll actually meet the costs of the Olympics.
And a year ago, I bet they wouldn't have done that, would they?
No, well, you imagine Berlusconi would have wanted to be out there being the big man giving out the medals.
That's right, wants to be a show pony, absolutely. Yeah. So if Italy has changed, and Italy, by the way, has been downgraded as well by Moody's, Italy, Spain and Portugal, and some of the other big economies, Britain, even Austria, have been put on negative watch by Moody's. What's that telling you as a banker?
As a banker, it says that we live in uncertain times, and funding globally is going to be volatility around that. Now, we hear the word volatility, we hear Sir Henry van der Heyden talk about volatility, and I think this is one of the reasons why businesses aren't prepared to take on the same risk today that they were previously, because they want to be prepared for the shock that everyone's saying may actually come.
And that's why nobody's investing, because people's mindsets now compared to what it was 5 years ago is completely different. Everybody's got a much higher focus on risk, and they want to be certain the return's going to be there. And at the moment, those returns aren't necessarily guaranteed in projects. And
so what do we do here in little old New Zealand then to begin to inch forward over the next 12 months?
We innovate, we collaborate, and we get closer to our customers.
Easy to say, innovate, collaborate, get closer. But what does that really mean? Give me an example.
Okay, in innovation, we don't spend enough. We spend well below the OECD average. It's an easy way where we can create jobs because we can invest in high value innovation and research and development, and we can create opportunities that differentiate ourselves in the market and command a premium. Without innovation, then we're going to struggle to do anything other than compete at a commodity level. Okay, we'll come back and talk about that some more after the break. Thanks, Ian. Coming up, NOSH and the price of milk. What does this tell us about the way we buy food? Where are the opportunities for producers? What's wrong with selling off our beef and sheep farms to foreign investors so they can turn them into pine forests? As long as we get the cash, does it really matter? And with some big changes in ownership in the past 6 months, what's the future for the horticulture sector? But first, answer this in our Farmers' Facts and Figures quiz. What top 3 issues lead Kiwi concerns according to UMR Research's special 20-year edition survey? The answer when we return. Stay tuned. Welcome back to Money Talks. Just before the break, we asked you what top 3 issues lead Kiwi concerns according to UMR Research's survey. Here's a clue. Economic and financial matters are consuming Kiwis. Number 1 worry, the economy. Number 2 worry, employment. And number 3 worry, the cost of living. What about the cost of milk? It all kicked off with that boutique grocery store NOSH and its position on the price of milk. Remember, it slashed the milk price at its 4 stores to $1 a litre and will hold that price until the end of the month. Ian Proudfoot, you've been watching this very closely. What do you find so intriguing? This is fascinating. And it's raising a whole question about how we're going to buy food going forward. If you look overseas, there's been a real shift to buying from these fresh food stores with a real focus on locavore products, i.e. stuff made locally and sold locally, where you've got that clear link between the quality of the producer and the supplier. And Nosh are clearly doing that, this strategy to get some promotion, get their brand out there, and also promote the fact they're bringing fresh New Zealand produce to the consumer.
Richard, do you think that the supermarket chain should be nervous about this?
It's competition, isn't it? It's fantastic. It's a very staple food item, and it's a point where they've chose to have a bit of a battle on it. So I think it's great for the consumer. It'll, I guess, provide a little bit greater transparency and most certainly some debate around where the margins fall on milk. We know that the dairy farmers get about 60 cents a litre, so where does the rest of it go? All those sort of discussions will be had.
Let's talk about foreign investment now. I know that, Ian, you've recently been meeting with a lot of foreign investors. You have very strong views about what they need to be bringing into the country if we sell off farmland. Tell me more.
The position that I'm clearly seeing is, if when we're talking to foreign investors, the key question we're asking in our own minds before we make a decision as to whether to look to assist them with what they're trying to do or not, is what are they bringing to New Zealand? It can't just be cash. We need capital, we need capital investment, but if we're going to have successful co-investment that's going to add value, we've got to have people that are, one, wanting to work with other New Zealanders and invest in New Zealand farms, invest in young farmers. But also we need people that are bringing some sort of innovation, they're bringing some sort of market access, they're bringing technology, they're bringing something we don't have as well. So the pie is going to be bigger as a result of that investment.
So ideally, what country should we be targeting?
Well, at the moment, we need to target Asia. We need to be out there proactively building relationships with Asian investors who want positive long-term co-investment.
And yet,
look, we can't see them as the evil investor. They're not. They're the people with the money. They're people with very great innovative markets, and they bring the future for us here.
They bring the future, but are they going to own the future, and are we going to be tenants in our own land? Look at the Crayford deal, still not settled, still before a high court. What does that tell you?
Well, just a couple of points. Firstly, I'm a bit of a fan of the family farm myself.
Of course.
Of course I am, and but I think we all need to understand that potentially that's not always going to be the way forward, and we do need foreign investment here to create development and research and all the rest of it, and open up doors for
Richard, are we going to be able to afford to have any family farms 50 years from now?
I think we most certainly can, and one of the reasons why that is if we actually look at the dynamics of farming right now, the return on capital is of the strongest they've been in probably 3 decades. So that actually creates a great opportunity for families to actually sit down and think really good about succession. Now, succession requires 2 things. It requires good communication, and it requires cash, and whether that cash is in cash flow or lump sums. So I think right now is a great opportunity for New Zealand farming families to sit down and think long and hard about family succession. And if they get it right, then there's not going to be the same impact of this corporatised farming model. But
So are you saying, in effect, if we don't get it right, we have nobody to blame but ourselves if overseas interests come in and buy us up?
I don't think it's only going to be overseas. I think if we actually look at New Zealand agriculture at the moment, it's a very attractive investment option. It's the returns are there, the tangible asset nature of it, the soft commodity story. So we're going to see onshore local New Zealanders who haven't traditionally invested in agriculture starting to invest in agriculture because it's better than other investment alternatives. So when we talk about family farms, potentially all existing farming families in New Zealand not continuing to buy the farms, there's other New Zealanders that may look to participate with them. And I think we need to think a little bit broader about how this may look going forward.
I think it's also not just a question now worrying a lot of farmers about who's coming in to buy the land if it's not going to be Kiwis. It's what they're going to do with the land. In Taranaki right now, there are 4 farms that are going to go up for sale, they suspect, to Europeans, and they're going to turn beef and sheep farms into pine forests. Should we worry about that?
Well, I think we should worry if the land's not being used for the optimal use of that land, because that's not going to create enough value to keep the country where we need it to stay. If a pine forest is the optimal use for that land, then that to my mind, is not a problem. But
what do you think?
Generally, for a pine forest to be the optimal use of the land, you're making some assumptions about the future of the ETS scheme. And I think then you're taking some big bets on how that's going to unwind over the next 30 years. And, before we know what Kyoto 2 looks like and where government policy is going to move, and it's clearly going to zigzag around as we get changes in government. But, there's some big gambles being taken on turning something into a pine forest, and once it's gone to a pine forest, it's very, very expensive to bring it back.
And saying that, it can be brought back though. We know that a number of dairy conversions or other conversions back to pasture on the Central Plateau, so it's most certainly can be brought back. So there's been reports saying that once it's in trees forever. Well, that's not always the case.
No, but it is expensive.
That's very expensive, yes.
I'll tell you something else that must be worrying most farmers now. They're all getting older. They're largely men. With aging demographics for all of us, how are young people going to be able to afford to buy into farming? What are your thoughts, Richard?
Well, I think it takes a lot of planning, and I think people need to start planning before they think they need to at a younger age, rather than getting to the late 50s, early 60s and thinking, right, let's start thinking about family succession now. I think it's an aspect of diversification of investment throughout your farming career. I think that currently, as I mentioned earlier, with the fact the return on capitals are there in agriculture, it actually does create an ability to fund a family succession program now. So I think that all these opportunities are right there for people now, and I think in my whole career in bank, I think the greatest opportunity is right now to actually put a lot of time and effort into thinking about it, and I think they'll be fruitful discussions, I'm sure. So.
Okay, thanks. Hold that thought. We'll come back. Coming up after the break, future proof on the highways and byways of the economic world as our experts point out what's coming up. But first, farmers have been urged to start registering for the National Animal Identification and Tracing Scheme, NAIT. So answer this in our Farmers Facts and Figures quiz. When will NAIT become compulsory for cattle farmers and for deer farmers? Find out after the break. Come back quick. Welcome back to Money Talks. Just before the break, we asked you, when will NAIT become compulsory for cattle farmers and for deer farmers? The new electronic tagging scheme will be mandatory for cattle farmers in July and deer farmers next March. And now it's time for future proof. What's coming up for our experts? Ian, I know that you've been putting your giant brain around the horticulture sector. A lot of ownership changes in the past 6 months. What's going on?
Well, it's interesting when you look at it. Obviously Turners and Growers has had to change in its majority shareholder now, and it's now controlled by a large German fruit and vegetable cooperative. You look at Scales, there's been some private equity investment coming to that. From
Direct Capital came in, yeah,
and
correct.
And Freshmax has recently received an investment from Maui Capital, swap of private equity owner there as well. So you look across the sector, a lot of new blood coming in, a lot of new ideas, and a lot of access to some new capital potentially. So my view is the horticulture sector has really needed to have a focus on how it increases its scale, how growers start to work together better, how we get out into international markets better. And maybe now we've got some new perspectives at the boardroom tables that can actually start to see some of that happen. So I'm actually quite excited about opportunities for the horticulture sector. I suppose if you take the kiwi sector and its PSA issues out, the remainder of the sector maybe has the opportunity to start moving forward when it's sort of been a bit on hold for the last couple of years. Yeah,
taking the kiwi fruit sector out, I hear what you're saying, but interesting that this past week bankers have been visiting the orchards there, trying to figure out how they can get involved with the farmers to in effect save this industry. What are you hearing?
The first comment I'll make there is that the people of the Bay of Plenty and the kiwifruit regions of New Zealand are showing a huge amount of resilience. It's a very difficult time for them all, and also the downstream processors, etc., are doing it very hard. And the KVH and the industry, I think, is working very well together and working very hard together to find solutions here. So when you sort of mention it's the banks propping it up, I sort of don't see it. I sort of see this industry helping itself to a large extent, and we're very keen to continue to support it. And there are a number of things there going on which we're very excited about, and we most certainly see a future for that industry. So,
but some of the farmers that have had to cut out their vines,
that's right.
They're saying it's going to cost them $40,000 to $60,000 a hectare to bring it back. How are the banks going to get in behind and help them?
If there's that kind of investment required, we think that kind of investment can take place and those businesses will remain viable. Now, obviously, every circumstance is going to be very different, but by and large, and this is why I kind of made earlier, we think the industry most certainly has a wonderful future, and there's obviously the G3 is showing a lot of positive results there. So, and we think with obviously if we look at the the quantum, 72 million to 75 million trays of green and 18 million of gold is expected at this harvest. So that's not the disaster. Look, it's not great either, don't get me wrong, but it's not the disaster that potentially people thought it might have been. And with the regrafting to more tolerant varieties, we most certainly do see a future. So.
Interesting, Ian, you talked earlier about the lack of innovation, certainly in research and development. What's your message?
Well, innovation is always something that gets cut quickly when times are tough. You know, it's one of those budgets you can turn on and off, like training, your talent development. Short term, they save you cash. Long term, they cost you a lot of money. And I think the trouble in New Zealand is when we're not in that sort of tough position at the moment, returns are actually really good. And as Richard said earlier, you know, we're probably getting returns that are in line with where we've been, highest we've been for 3 decades. But we never had the tap turned on before, and we're still looking and saying there's a lot of uncertainty in the global economy, so we're just not freeing that tap up. We need to spend on innovation. The challenge that we've got now is that we've wound down our resources around innovation so far, but we don't actually necessarily have the people here ready to wind up spending. Massey's doing a great job building connections with overseas international agricultural universities and creating the relationships that enable to bring some of the IP being created overseas and therefore on a much lower cost basis work out how that works in New Zealand.
Yeah, the synergy, which is everything. Make friends, make business. I'll tell you, Richard's been out there on the world stage, Ian. We'll be proud of him. We got to pat him on the back. You were in Kansas recently. You were called in to talk to farmers there, American farmers, about why they shouldn't have subsidies.
Yeah,
tell me about that.
The whole Ag Symposium they had in Kansas City was about managing business risk for them, for American farmers. And one of the challenges they have, or I guess current benefits, is they are subsidised in many aspects. And I guess ethanol production is probably a key one that we're fully aware of here. And I guess we just challenged them a little bit about potentially what their industry would look like without subsidies. And it's obviously something the New Zealand agriculture industry went through in the 80s, and it created a lot of pain and difficulty. But farmers are resilient people, and it's a resilient industry, and I think if we sit and reflect now where we are as an industry, if you're in a deregulated market, you have a much more efficient allocation of capital, and I think we're benefiting from that now. We're operating on a free market on the global stage. It's great, whereas in the States they don't have that, and it was just a challenge we made to them, and they sort of looked at me as if I had a third eye growing out of my forehead, thinking that surely we're going to be subsidised for the rest of our lives, potentially a little bit of the attitude we might have had here back in the early 80s, and so it was an interesting discussion to be had with them over there. So.
What do you think the dairy farmers were thinking about your message? Because American dairy farmers they do not want to come to the party.
No, they don't. I guess one of the challenges for the American dairy farmers is they're largely confinement systems, and the ethanol subsidies are pushing the price of grain up, in particular corn, for them. So they're probably at a neutral position in effect. But yeah, they're not quite as good as the French for protecting their industry, but they might be pretty close. So,
of course, the United States, Ian, they're facing their own demons right now with their economy in a nosedive. Talk to me.
Nosedive, I think it's probably flattened out now. I think it's probably maybe been through the worst. But what is absolutely certain is the US government's finances are in a horrible position, and the Farm Bill is, particularly for the Democrats, an area they can focus on for cutting costs and cutting costs quickly. So I think for a large number of American farmers, they're going to find the support they've been used to receiving is going to be scaled back reasonably quickly.
What kind of
unless
support?
we see a change of president, and I'm not convinced that's going to be the case.
What kind of support will be cut back? Are you picking?
Things like the insurance programs they've had for crops, where effectively they've had subsidised insurance. Some of the direct support programs around biofuels and ethanol, I think they're clearly programs that are skewing the market and having a real global impact. So those are the sort of things I think we'll see being reduced or cut back.
And they will impact us here directly in New Zealand, especially with the ethanol situation, because there's likely to see increased milk supply out of the States, and with the way the currency is, and they're such a big dairy producer, albeit not a big dairy exporter, that could have an impact for us here. And hence we have Sir Henry Van Hayden continually talk to us about volatility. These are some of the things that's difficult for us to predict, and these are some of the catalysts for the volatility that we have to farm through.
Thank you very much, both of you. Thanks to my guests, KPMG Agribusiness partner Ian Proudfoot and Head of Agribusiness for BNZ, Richard Bowman. Be sure to check out our website. Meantime, according to a professor at Massey University, men are risk takers even with retirement savings. It seems men are more likely to invest in aggressive and growth funds, while women are more likely to choose conservative funds. You think? I could have told you that just watching this video. Keep the faith. See you next time.